Hello clients and friends, this is Dennis Goodman of Bowmill & Goodman Financial Strategies, and it's my pleasure to welcome you to our Economic Review and 2022 Outlook. Today we'll be providing a brief review of the fourth quarter of 2021, and then we'll discuss our economic outlook for 2022. Before we begin, it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. Today's presentation will primarily focus on investment planning and equity markets. The U.S. stock market ended 2021 just shy of all-time highs. The S&P 500 closed the quarter at 4766, ending the quarter up 11% and the year up 27%. This marks the third consecutive year the S&P ended the year with double-digit gains. The Dow Jones Industrial Average closed at 36,338, ending up the quarter almost 8% and the year up 19%. Since the quick but sharp fall of equity markets in early 2020, post-pandemic equity markets have been primarily robust. Despite many potentially detrimental events, the equity markets showed resilience and prevailed, rewarding investors with notable gains. 2021 saw many new records broken. The S&P 500 had 70 record closes, and the Dow also saw some significant gains with 45 record closes. Stock values have soared, and many analysts are crediting ultra-low interest rates and a healthy economic recovery for the surge. As you look at this 40-plus year chart of the Dow, you can easily see that stocks have increased over the long term, notwithstanding market pullbacks and dips. The sharp decline of 2020 looks a lot less threatening as you look back at the long-term results. That's why having a solid investment strategy is an integral part of a well-devised long-term financial plan. Staying disciplined, not getting emotional, and following your strategy during times of volatility can be crucial, and it's important. While investors enjoyed an overall strong return in 2021, as the monthly S&P 500 return chart shows, monthly returns were very inconsistent. Equity markets don't move in a straight line, and the past few years have been an excellent reminder for investors to be prepared for anything that could affect economic environments and their own personal situation. Volatility is a part of the investment experience, and seasoned investors understand that. Bond yields for 2021 were low. In mid-March, we saw the highest 20 and 30-year yields on the U.S. Treasuries for the year of 2021. Subsequently, they dropped back down, ending the year at 1.52, 1.94, and 1.9 for the 10, 20, and 30-year yields, respectively. 2021 was not a great year for bondholders, and while today's interest rates are still historically low, the Fed is expecting to raise interest rates several times in the next 2 years. When interest rates rise, the demand for bonds typically falls, reducing their prices and raising their yields. Thus, 2022 will be an interesting year for bonds. Research is indicating that Treasury yields could go up, ending 2022 with a 1.5% to 2% yield on 10-year U.S. Treasuries. As I mentioned earlier, interest rates continue to be ultra low throughout 2021, and these rates clearly are undesirable for income-seeking investors. Bank money markets and the average 12-month CD rates were both less than 0.2%, which is very unattractive to savers and investors. During the Federal Open Market Committee's meeting in December, it was announced that the federal funds rates will raise in 2022, and the Fed expects 3 rate hikes this year, following by 3 more in 2023. They project the hike at the end of 2023 by the federal funds rate would rise to somewhere around 1.6%, and in 2024 end the year at approximately 2.1%. The Fed's been making lots of moves. They also began the tapering process this past fall, with the ultimate goal of ending the pandemic-driven stimulus by mid-March of this year, several months earlier than their original goal of November 2022. In December, due to the elevated labor market and inflation pressures, the Fed decided to double down on their pace of their reduction of asset purchases beginning in mid-January. Inflation rose the fastest pace in nearly 4 decades in December of 2021. The number reported was 7% versus the prior year. Seema Shah, chief strategist at Principal Global Investors, stated, and I quote, "Inflation at 7% is no joke. It's the highest annual number since 1982 and was driven not by energy prices, but by just about everything else." End of quote. While analysts feel December's number could mark the peak for annual inflation readings and signs that supply chains are easing, other experts suggested the rampant spread of Omicron variant could bring about difficulties for the global supply chain. Many analysts feel that the tapering process of the Fed could slow inflation down. Inflation is clearly something we'll be watching closely in 2022. So what are analysts forecasting for 2022? Well, 2022 could be a volatile year, so our goal is to keep our clients apprised of any potential activity that may affect their financial situation. In addition to continued COVID concerns, 2022 is projected to bring rising interest rates, continued but hopefully lower inflation, stimulus tapering, and a slowdown of the global economy. Also, let's not forget any public policy and new tax laws will bring changes to monetary policy. What does all this mean for investors? The returns we've enjoyed the last few years were well above average and the typical median of the past 20 years. However, there are still many economists who feel that rates are still low and we should be optimistic and still be looking at favorable returns, just in a more moderate mode. As we've seen in the first month of 2022, volatility has reemerged. Stock market volatility can speed up when external events create uncertainty. Currently, the potential political conflict overseas in the Ukraine, the Federal Reserve's shift in policy, and the resurgence of inflation have all been noted as contributing factors to the recent equity market volatility. Now, volatility doesn't mean that stocks are headed for a down or a long-lasting bear market. Even when there are market declines along the way, an investor can still experience reasonable returns over a long period of time. It's important for investors to be aware that volatility and risk are not the same thing. For stock traders who look to buy low and sell high every trading day, volatility and risk are deeply intertwined. Volatility also matters to those who may need to sell their equities in short time frame, such as those who are older and closer to retirement. For long-term investors who tend to hold equities for many years, the day-to-day movements of those equities should not affect their long-term plan. Volatility is part of the noise that comes while you allow your investments to compound long into the future. Long-term investing still involves risks, but those risks, most of the time, are related to being wrong about a company's growth prospects or paying too high a price for that growth, not because of volatility. As this chart shows, declines are a normal part of the investment cycle. Volatile times can create market drops that can be uncomfortable, but they're not unfamiliar. Downturns are part of the investment experience. So what should an investor do in a volatile market? First, make sure you know what not to do, and that's panic. In times of market volatility, investors tend to become unnerved and anxious. This is not the best mindset to make rational decisions. When equity markets experience unsettling fluctuations, we suggest you ask yourself 3 questions. 1, have my financial timelines changed? 2, have my financial goals changed? And 3, Has my risk tolerance changed? How you answer those questions will determine what, if any, actions you need to take. While the most recent variant of coronavirus, Omicron, is being seen as much less of a threat than its predecessors, and vaccines are now widely distributed, it's still a central figure in the direction of the economy and its recovery. We were reminded in November, when the news of Omicron was released, that the markets are still very vulnerable to the trajectory of coronavirus and the introduction of new variants, as it directly affects supply chain disruptions, labor shortages, and further downward pressure. Even though the equity markets have seen impressive returns, complacency should not settle into investors' attitudes towards their investment strategies. We're still standing by our mantra of proceed with caution. We also still maintain that an educated client is our best client. So here's some things we're looking at. Well, with interest rates on the rise, we feel it's beneficial to review all of your income-producing investments. If applicable, lock in your mortgage rates or consider refinancing to get a better rate if you haven't already done so. Maintain liquidity for all near-term needs. Reevaluate and confirm your cash flow needs. Sometime this year, conduct a full review of your financial plan with us. During the review, we can look at risk management, how well diversified your plan is, and revisit your time horizons to make sure all of these items are still compatible with your goals. Remember, the volatility that's returned this year is part of the investment experience. Market pullbacks and downturns are not uncommon. Having a long-term strategy and staying away from emotional investing decisions can help you ride the pullback waves and stay on track to your financial goals. As a reminder, focus on your time in the market, not timing the market. For example, selling equities during a downturn can help you retain your gains. But if you're still on the sidelines during an upswing, it could prove disadvantageous to the overall performance of your portfolio. If you have questions or concerns, now is a good time to revisit your financial plan with us, including your time horizon and risk tolerance. So as a recap, equity markets ended on a high note in 2021 despite many potentially negative variables. Inflation is still expected to be prominent in 2022. The Fed announced we should expect 3 rate hikes this year. Tapering efforts of the Fed will double starting in mid-January. Volatility could be on the horizon, so caution and vigilance are critical. Review your own personal goals and objectives. As your financial professional, we're here to help you pursue your goals. One of our main focuses is to review potential changes our clients make on an ongoing basis. Prior to making any financial decisions, we highly recommend you contact us so we can help determine the best strategy. There are often other factors to consider, including tax ramification, increased risk, and time horizon fluctuations when changing anything in your financial plan. You can also expect to continue that we'll communicate with you as we're continuously monitoring economic, tax, estate, and investment issues for our clients. We appreciate our clients, and as a client benefit, you can add names to our viewing list for these workshops that we present, and we hope you'll take advantage of this and add a few names to our list. One of our goals in 2022 is to help more people just like you. Some of our best clients were referred to us by existing clients, so please feel comfortable sharing the names of anyone who you feel could benefit from this information. We believe the best client is an educated client, and our goal is to keep you informed, so we thank you for watching our update. We appreciate the opportunity to assist you in your financial needs. Please let us know your preference on meeting format going forward, whether you like them in person or virtually. Remember, at our firm, clients come first, and your health and well-being are our highest priority. Best wishes for a great and healthy 2022. Please call us if you have any